It's been an interesting week in the oil markets. Up until last weekend, we'd got a rally in place that had taken both Brent and WTI up to levels not seen in many, many months. And then, of course, came the weekend with the Yemen-based Houthi rebels with the drone attacks on the area in Saudi Arabia where the Saudi Aramco facilities are, and that drove the price up even further. Since then, we've seen a little bit of money taken off the table. There's been this retracement, but we've got to keep in mind what OPEC is thinking about all this. We've seen those supply cuts put in place a while back, and the most recent meeting between OPEC and non-OPEC nations, they suggested that they wanted to see those cuts kept on, which would continue to support prices. But where do we go from here? Well, Sam Wahab is an oil analyst at SP Angel. He joins us now on the line. Sam, it's good to talk to you. What do you make about the forces driving the oil price at the moment? Going into last weekend, we got that rally in place. Talk to us a little bit about the fundamentals.
You're right, Jeremy. It's been a very volatile and sort of forward-looking year to date. The oil price alone has been up 35% on a Brent level, and I think much consensus is for that to continue. Indeed, many of the large investment banks, JP Morgan, Goldman Sachs, to name a few, have already pegged towards the end of this year anywhere upwards of $80 per barrel on a Brent basis. So I think all factors are pointing to the upside, and you're right. It's been pushed along by fundamentals, supply and demand, but also the perception of future fundamentals and where that's going to be. I mean, at the moment, it's very hard to peg what global supply and global consumption actually is at the moment. So analysts, traders, and countries are really pegging where they believe it will be, and that's really still being underpinned by the ongoing pandemic and the vaccine rollout and how the individual countries are responding to that. In terms of looking ahead, I mean, we're still in a very deep period of economic uncertainty. Different countries are responding differently to the vaccine rollouts. And in terms of when we're going to get back to normalcy, I think we're still in a period of huge uncertainty. Then you feed into what else is driving these fundamentals, and we've seen a lot of stimulus packages being thrown into the global economy. I mean, last week alone, the US put 1.9 trillion into their stimulus package, and that's pushed the oil price as well further. The European Central Bank has done much of the same, so there are other concerns around inflation. But in terms of supply and demand, I mean, we can't forget the news from last week and OPEC Plus's meeting, where the general consensus ahead of that meeting was that there would be additional barrels being put on the market, but indeed for no barrels to be put on, and continued reduction of 1 million barrels of oil per day on behalf of Saudi Arabia was unexpected, and it pushed the oil price Friday alone 5%. And then on a geopolitical standpoint, Sunday, we saw that, as you mentioned, the Houthi rebels performed attack on some Saudi infrastructure, which again pushed the oil price not too dissimilar to what happened in September 19. So there has been a lot of factors really driving this, but where we go from here, I think will still be predicated on how we respond to the ongoing pandemic.
It's an interesting point you mentioned about the fact that markets, they do price in future positioning, don't they? But do you think that the fundamentals justify $70 a barrel for Brent? Let's talk about Brent as the benchmark. I mean, it did hit that level. It's since pulled back a little bit, a couple of dollars down. But broadly speaking, do you think that the fundamentals as we have at the moment do justify this price? Or do you think the markets have got a little bit ahead of themselves?
I think they do justify where we sit today. There is a huge tightening on the market from a global standpoint, notwithstanding Saudi Arabia, but also the US, which it clearly isn't part of OPEC or OPEC Plus, but they're currently producing 10 million barrels of oil a day. Let's not forget that the US is one of the largest consumers of oil in the world. They're currently 3 million barrels per day lower than they were pre-pandemic. So we're talking huge numbers that have been pulled out of the global supply. So I do think there is a justification of being at touching $70 oil when we were probably around 65 pre-pandemic. So to only be $5 a barrel ahead of that and be in a situation where different countries are responding to this vaccine, the consumption levels are growing. We've seen that through kerosene and gasoline in the US, which means fuel consumption is increasing. And then we just look at other macro factors, the super majors, for example, the Exxons, the Chevrons, the Shells, BPs. Yet last year they reduced capex spend 5 years worth in 1 year. That's extraordinary levels of reduction in capex. So to see that feed through, I know we're only talking about current fundamentals, but again, perception of future fundamentals, that's extraordinary. And we'll see that when there is a correction to the upside from consumption levels, that there simply won't be the supply there to meet it.
Yeah, it's interesting, isn't it? Also, listening to some of the anecdotal commentary from some of these oil majors that we've seen. I think it was Total just a few months ago saying that they thought that peak oil was 2019. We've seen this big drive, of course, haven't we, with some of these big multinationals trying to emphasize more on their credentials on the green side of powering the world and moving away slowly. We saw last night, I think it was Chevron mentioned this. We know that ExxonMobil's got a plan in action, but of course the US big oil companies are well behind us here in Europe who've got these plans in place. They have done for some time now. But with all this in mind and what's happening with the move in the market, are you happy that there is a future in oil? I mean, it's going to take a long while before we wean ourselves off the black gold anytime soon. But do you see this shift as being significant, do you think, with these big oil companies emphasizing more about their green credentials?
I think you're absolutely right, and there is a shift, and I think you'd have to be blind to not see the global dynamics changing. And it's interesting that you note there the sort of division between the European super majors and indeed the US. Chevron and Exxon, for example, are probably slower on the take up, whereas BP, Shell, Total are very much their net zero plans to, well, I think Total sooner than 2050, I think believe it's 2035, so they're a little bit further ahead on the curve. In terms of the question regarding whether there is a future for oil, we've got to understand that most of the transition from super major level is coming from the West, and there are 7 billion souls on the earth. In terms of future expansion to 2050, most of that will be from non-OECD countries. So, and that'll be a population explosion where the infrastructure for a greener sort of landscape for energy usage just isn't there. And in terms of future infrastructure developments within those countries, they'll be some years behind, decades behind where we are in the West. So in order to meet that energy requirement, black gold will have to fill that void until, on a global landscape, that greener ways of sustaining oil energy consumption can happen on that level. In terms of where we are in the West, yes, I do think there will be a transition. Many commentators are saying that that many of the majors are paying lip service to their income-only ESG reliant investor base. But I think it's more than that. I think there is a real sort of push within the super majors to augment their existing sort of fossil fuel-led portfolios with greener technologies. It's interesting, a couple of weeks ago, Shell put out their sort of green outlook and how that is going to play out. And in terms of oil production, I think from their 1.9 million barrels of oil a day total group production where we sit today, by 2050 it only reduced to 1.8 million barrels of oil a day. So not a huge material decrease. And in many ways, what they're planning to do is to augment and double the size of the business by 2050 through the greener technology. So it's not really, replacing oil and gas. It's merely just augmenting at this stage at their future plans. So yes, I do think there's a place, but in terms of fully replacing oil and gas, I think that's a bridge too far for our lifetimes.
Yeah, for our lifetimes, exactly. I mean, you would say all this, of course, you're an oil analyst and you're focusing on this, but nonetheless, that is a big picture story. I fully understand that. Let me just get back to some more immediate news that we got. We saw that you mentioned just a short while ago about OPEC recently. We've got this deal between OPEC and non-OPEC nations. Primarily, it's a relationship between Saudi Arabia and Russia, this OPEC plus body that we're now hearing so much from. Before we take a look at where they position themselves, what do you make of that relationship? What do you make of the longevity, the potential for that relationship to continue? Because that is very much in place, very much part of the moment. And without that relationship, I think it would be more difficult for them to agree any sort of a deal whereby we see the amount of oil coming off the markets, which is supporting these prices. What about that relationship between the two?
Yes, it's a very interesting relationship, notwithstanding the interdependence that both countries have on each other with regards to sort of massaging oil prices. I mean, both economies are reliant on the oil price. There's no getting away from that. Obviously, the Kingdom of Saudi Arabia more so than Russia, which is more diversified to other sectors. But in terms of the fragility of the relationship, I think that's already been seen. It blew up spectacularly last April, last May, where there was almost an oil price war. They both decided to flood the markets, and we saw a negative print from the WTI perspective. So in terms of where we go from here, I think there have been lessons learned from what happened last year. They've seen that they shouldn't really be falling out in that way, and they need to support each other and support oil prices and indeed their economies. Now, what we've seen over the first quarter of this year is that Saudi Arabia have decided to take it on the chin, basically, and reduce their output by 1 million barrels of oil a day. But they've allowed Russia to continue as they are. Indeed, this month we've seen that Russia have increased their April quota by 130,000 barrels of oil a day. I think that's mainly because of seasonal consumption trends within Russia, and therefore there is a requirement for their population to have more energy at this time of year. But indeed, it did show a relationship and a strengthening from, as I say, what already was a fairly fragile relationship as we look towards the back end of this year. Clearly, I think they understand each other's strengths, and there is potential for this support to continue, especially during these uncertain times. But I concede that it is still fragile, and they are very volatile governors of their countries.
What do you make of the chances of this amount of oil that's currently off the market staying off the market? Clearly, there's a need to do that. I think we just saw the American Petroleum Institute, didn't we, come through its weekly oil inventory numbers, which were showing a far bigger rise in oil stocks. So I think there's obviously an argument, I guess, to keep this extra oil off the market. Do you see that as being something that's going to continue for any length of time, or do you think that at some point we will see that oil come back on the market sometime over the summer?
There is currently what analysts can estimate around 5 million barrels per day being held back from the market. And you're right, yesterday's figures from the API showed quite a significant build of 12 million barrels compared to analyst consensus of over only 800k. And that follows the week before of a 21 million barrel build as well. So they're fairly chunky numbers here, and that is really pushing or holding back the WTI price in the US. In terms of new barrels hitting the market, Saudi Arabia post the OPEC Plus meeting said that they're leaving their unilateral 1 million barrel a day cut open-ended. So there's no firm date for when they'll start phasing more barrels back into the market. I think they'll stick to that. I think from their point of view, producing what they're producing today at $70, $75 oil is much more economically beneficial than fully producing at $40 or $50 oil. So economically, it stacks up for them, and I think they'll go in a phased manner. In terms of when it will return to normal, that all really depends on when the global economy starts to recover, and we are at sustained levels of pre-pandemic oil and gas consumption. I mean, in terms of reducing the output, OPEC Plus did say, when they were questioned on the potential for shale to sort of resume in the US and what that will mean for global pricing, they were pretty adamant in that the shale won't resume in any sort of major way, because the US banks won't lend to shale producers on the basis that there isn't sustained pricing for a long enough period of time, and there isn't pre-pandemic consumption levels there. So I think they're fairly sort of happy that that's going to continue to be the same. And in terms of when these barrels will hit the market, it will only be as and when the pre-pandemic consumption starts to recover.
At SP Angel, of course, you have a number of clients in which you're interested. Just give us an outline of 2 or 3 companies that you're looking at the moment, and what your thoughts are in terms of opportunities given this rise in the price of oil.
Sure, absolutely. I mean, there is 3 that I've got a keen eye on at the moment, probably on the sort of lower or the mid area of the market. Less so in terms of oil, but a recent corporate win of ours, Sound Energy, which has the most material onshore gas acreage in Morocco, where they've got very robust pricing levels. So this company, I think, has been a bit overlooked for the last 9 to 12 months, and sort of flown under the radar, but they're doing some extraordinary things with the new management team. We're on the cusp now of signing new deals to build a mini LNG facility for their phase 1 gas monetization of their huge Trendara gas field, and then they'll move into phase 2 in 2024, which involves building a pipeline into the wider areas of the country. So that could be potentially transformational for that company, and some very exciting times ahead for them. Another one we're looking at, which is not a corporate client of ours, is Canadian Overseas Petroleum. They have recently signed a deal with Atomic in the US to buy some very significant oil production producing acreage there in Wyoming. That has the potential to increase from 1,400 barrels of oil a day to 7,000 barrels of oil a day in quite short order. Now, if you consider what the oil price has done this year, they signed it when the oil price was $39 a barrel WTI. Now we're at, touching $65 a barrel. So it's a significant uplift for them, and there'll be a huge valuation catalyst for those guys. And that has been sort of evidenced by a $65 million bond facility that they will soon be signing. And even yesterday, they were backed by the equity markets to the tune of £14 million. So some really, really good outlook for them ahead. So that's some exciting times for those shareholders. And finally, we are also following PetroTal quite closely. This last year was a very, very tough year for the sector in general, and in particular PetroTal. Their Britannia field in Peru was shut in, so there were a very, very big disruption to oil sales. We've come into this year with a completely recovered oil price. The Britannia field's back open, and now they've got a view to increasing their net production to 20,000 barrels of oil a day. That's double the current rate. So very impressive financials we'll see from them going forward this year.
Interesting, Sam. Thanks so much indeed for joining us. It's a pleasure talking to you and being able to get a chance to get up to speed with you again, especially on the price of oil, where we go from here. It's good to talk to you. That's Sam Wahab. He's an oil analyst at SP Angel. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.